Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, now, after 2 decades in Florida, you say you like the change of seasons. Well, winter showed up this last week, David. Are you still enjoying the changes in the seasons?
Absolutely. And we actually had some friends from out of town that we work with were in town from other parts and like, is this normal? I'm like, yeah, you get 1 or 2 of these every year for sure. So, I like it when the snow is heavy. You get a nice, 5 inches or so, and then you just get the roads cleaned up, and then it's pretty to look at. And I live, I'm blessed to live on a golf course, so that snow out there on the golf course looks really pretty.
I suppose it is.
So out my back, it looks pretty. The front, not so much with the traffic or something, So, but as long as I get the initial shoveling done, and I was out early in the morning. I was out there about 4 a.m. on whatever was that Tuesday morning in the big snow. Yeah, started shoveling out there because we had actually given. I meant to buy a new snowblower this year. I gave mine away to somebody.
Oh no!
So I was old doing it by hand, but anyway, got it done. Certainly could use the workout. So
my mother and father-in-law gave me perhaps the greatest Christmas gift I will ever receive, a snowblower about 15 or 20 years ago, and wow, have I gotten some mileage out of that.
I know it's you can they are pretty convenient when you have them. So
yeah. All right. Well, despite the elements, we persevered and had our first round of classes for the new year, 80-some that we're going to roll out over the course of the year. Smart Social Security Blueprint, and if you have it, they will come. The people did come. We had another great round of classes.
Absolutely, and they braved the weather and got some good information, and we've got some more classes coming up here. Was it next week or the week after? And
then, both, actually, because Michael Luna is going to be on the second segment of this show today to talk about smart insurance protection. He's going to teach a round of those classes Thursday, January 18th, 10 a.m., or 6:30 p.m. They're both right here in the Midwest Learning Center at Retire Smart. And then, David, in December, one of the new classes we rolled out was the Smart Spend Down Solutions class about how to manage your assets, utilize Medicaid, especially for things like long-term care. Well, that one, the first class filled up so quickly, we offered a second. So we're going to offer another double batch here, Saturday, January 27th, 10 a.m., or 1 p.m. Saturday, January 27th, 10 a.m. or 1 p.m. That also is right here in the Midwest Learning Center. And since that one is still relatively new, can you give us a quick rundown? I suppose you and Michael Luna will touch on that as well.
Yeah, we can briefly touch on it. But, basically it's to help you understand how when it gets to, and sometimes this is really almost more for most of our listening audience as parents, you get to the age where you may need some help, whether it's home health care delivered in home or moving into a facility like assisted living or full-blown nursing care or memory care, et cetera. The problem is, obviously, most people are pretty aware that these facilities, which are gotten so much nicer over the years, they're very nice facilities, but they come with a bit of a price tag, Chip. And this is something I know. We're working on a home for my mom right now, but you have to spend your money to get down. And if you want the government to give you assistance through Medicaid, you need to understand the rules, and it's very different if you're single versus married, how much you can spend down. But in most states, you got to spend everything down to $4,000. Well, we can show you that doesn't really have to be the case through proper planning. And we can do the planning, whether we'll call crisis mode, where somebody's already in the home today, or they're thinking about going in the next 12 months, or this is something you want to plan for, 3, 5, 10 years out. We have things you can do now to plan for that as well. And so it's a really, really nice class. They partner with an attorney, Colin Kastrick, who we've had on the show many times, to help you understand how the rules work both here in Nebraska and, of course, across the river in Iowa.
Smart insurance protection and smart spend down solutions. Like all of our classes, there's no charge and there's no obligation, but you must register. Give us a call. We need to know if you're coming. 402-369-7777. We'll give you that info again before we sign off today. All right, David, into the news we go. And at first blush, for most news agencies, the coverage of the December jobs number was positive, but, well, Here's the headline from Fox Business. U.S. economy adds 216,000 jobs in December, beating expectations. But the news wasn't all good.
Well, no, we had our 17th consecutive month of downward revisions or whatever it was. Might have been the 17th, excuse me, but revised down. So the previous 2 months we knocked down by 71,000 jobs. So, it's like a game of smoke and mirrors. And again, we keep talking about the two different surveys you can get, the BLS survey, which is the Bureau of Labor Statistics, and what's called the household survey, where the government calls 60,000 households every month. And the numbers are very, very different, Chip. According to the household survey, we've actually lost 3,000 jobs this year. That's a $2.8 million or job discrepancy.
Well, the Fox Business Story notes that, you talked about these retroactive downward revisions
yes.
month by month by month by month. And so the economy added 2.7 million jobs in 2023, but that's down from 4.8 million in 2022.
Which was mainly the recovery. It wasn't really new jobs. That was obviously people just going back to work post-pandemic, et cetera. So, the proof's in the pudding, Chip. Our government receipts are not up, right? And so if we had these 7 million jobs, hypothetically, between the last 2 years that the government is telling you got created, you would think we would have increase in federal tax receipts from income, right?
Right.
That's not the case. It's down about 20%. So
even the jobs that are showing up, they're not all that great.
Well, yet we're seeing wage inflation at rates we haven't seen in a long, long time. So we see good wage inflation. But when you dig into the numbers, you'll find we have the highest amount of people working 2 full-time jobs, the equivalent of 2 36-hour-plus jobs. There's almost 9 million people doing that currently in the labor force, and we have labor force participation still hanging in right at 62%. So this also makes me want people to understand is there's a lot of hope, and the market had a pretty nice rally, year-end rally, right? All based on, the Fed's going to cut rates, and they're going to be really aggressive. Well,
you don't expect that to happen necessarily, do you?
No, because they can't. They're mandated, right, to get inflation to 2%. So we have CPI out this week. And again, we're still hovering core year over year, right around 4%, twice their target of 2%. So that means, can they lower rates? No. In fact, it could tell you they'd want to go the other way. I don't think they will. And then the second mandate is full employment, which is considered 4% or less on the unemployment number. Well, we're down to 3.7%. We're improving the employment number. So, those that want to hear about a Goldilocks or soft landing, again, I don't really think that's really truly going to happen, but that is what you're starting to hear from the talking heads. Well, if that's true, then the Fed cannot cut rates. Yet, the same token, at the same time, we see these same talking heads saying, whoa, the Fed's going to cut 7 times this year. I don't think so. So I don't think the Fed can cut until the second half of the year, at least at the data I'm looking at right now. But obviously, things are changing. My opinion certainly can change. But it's very confusing because we're getting data that doesn't align from the traditional sense of what we're used to seeing. And like I said, I'm coming up here in March. Will be 26 years that I've started doing this. So, I have a little experience. I've been through 4 bear markets, multiple presidencies, multiple administrations, and we've never seen discrepancy in data like we're seeing now.
One place where the job count is decreasing rather than increasing, you sent me this headline, David, from CNBC, Xerox to cut 15% of its workforce. David, that's 3,000 people.
Yeah, we're starting to see jobs rack up. There's a lot more I could have sent you to, and we'll probably cover a couple of those next week. A company called Unity's fired 25,000 people this week, or 25% of their workforce. We're seeing the markets. Barclays Bank, we talked about the banks. They're firing 6,000. That was out on Tuesday morning this week. 6,000 banking jobs internationally. Now, that's international, not just in the U.S. But again, we're starting to see the job cuts start to pile up. Now, we're going to go through a switch at some point, Chip, where we've been to this unique situation where sometimes bad news is good news for the market, right? Because it meant the Fed would help them. It would give looser monetary policy, or the hope of the aforementioned rate cuts would happen. Well, we're going to start to see that switch flip at some point, and I don't know exactly when, but all of a sudden the market's going to say, wait a minute, bad news is bad news. And this does happen from time to time. There's the old adage on Wall Street, buy the rumor, sell the news, right? So when we see that, when we see more and more bad news come, and then the markets sell off on bad news versus going up on the hopes the Fed's going to come to the rescue, that's when we're probably really into a real recession. And again, I still believe you'll see one here in 2024.
David, this medium of radio is one of the main ways we communicate with the public. And another CNBC headline, largest U.S. radio company, Odyssey, files for bankruptcy protection. What does that say to you, David?
Well, you and I have both been veterans on radio. I've been doing, financial radio for 15 plus years in multiple states. You've worked in radio in some form or another for the last 2 decades on and off. Radio makes its money from small businesses, right, and advertising. And I know we buy advertising. That's how you and I met, right? I bought advertising from you, and and sponsored the show, et cetera. So when the radio companies can't cover their expenses and have to file bankruptcy, that's telling you they're leveraged too far. And your old employer changed hands at one point, and then we see the big one. And we are on several of the iHeart radio stations, but iHeart's another huge radio provider here in the country, Cumulus Broadcasting, et cetera. We're seeing all of them; they're leveraged to the hilt, and so if they can't cover their debt service, they have to go for protection. And in business, just understand, it doesn't mean they go away. Bankruptcies are common in the corporate world because they reorganize, and basically a judge and a trustee will set up what their payment schedule is. But according to this, they're going to be able to wipe out like 65 or 70% of the debt load that they owed, and so that's going to get basically written off when they'll make payment plans and reorganize to come back. But we're seeing a record number of business bankruptcies across the country, and nobody seems to be covering those stories.
Well, so there's the story behind the story that Odyssey has to do this because its advertisers are having to pull back because they're hurting.
Yeah. I mean, it's very simple. And in fact, we sponsor a local Christian radio station. One of the stations, our show is not on it, but KGBI is my wife's favorite station. So I'll just give them a plug. Life 100.7. Forgive me if I got it wrong. But we sponsor multiple of the Christian concerts and artists. It's just something we personally like to do. But I had a conversation with them. One of their big supporters, another local small company, had to pull back because the business that business was in is going through a very rough time right now. And so that is, just multiply that across the country for paid advertisements, whether it's for nonprofits or profitable radio stations. The small businessman is hurting right now. And we just saw that from the NFIB, Small Business Index, Consumer Index of small business owners. Their confidence and optimism is starting to wane. And of course, that is the engine that drives American job growth and productivity.
Times are turbulent, economically, financially. Don't panic. Get the report card, 402-369-7777. It's a complimentary review of your entire financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now's the time to find out, and we will offer recommendations for how you might want to navigate in these uncertain times. The complimentary report card, 402-369-7777, 402-369-7777. Up next, we have another round of classes on insurance protection and asset management coming up. Here to tell us about it is Michael Luna of Smart Protection. He's up next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Two of our most popular classes, Smart Insurance Protection and Smart Spend Down Solutions, are just around the corner. One of the presenters of those classes joins us now. David, please introduce our special guest.
Thank you, Chip. Yeah, welcoming back into the studio Michael Luna of both Smart Protection and Senior Asset Solutions. I want to touch on both those companies today, but anyway, we had probably had a few insurance claims going on in Omaha this week. Maybe a few fender benders, a little slip and sliding going on with all this nasty weather this past week, huh?
I myself almost got into an accident coming in this week.
Man, yeah, when you did some travels, you were out in sunny California, weren't you?
And then I get hit as soon as I get back with this weather. My flight luckily didn't get delayed. That's what I was worried about.
Yeah, so, and that trust me, as much as I fly, and I actually was in San Diego at the ending part of the week. You were in California at the beginning part of the week, but getting your flights out of here on time. That's why I always book for myself the 5 a.m. out because it rarely is delayed. My wife's like, if she's going with me, I always have to do like a 10 a.m. flight. She really won't do the 10 a.m. But anyway, I was out at a tax conference. That was good. So you were out seeing sunny California with some relatives and good stuff. Come back, wallop into the beautiful weather that we have. Real winter has shown back up. But let's just talk about people that are out there maybe struggling, especially if they have a claim and they're going to have increases potentially in their premiums. But we're seeing a rash of people that can't even get insurance now. What's going on?
Bottom line is that the bottom line of these insurance companies is not looking good. And so they are raising prices, obviously, raising the share of cost that you as a consumer pay, quote unquote, deductibles. And they're and some of them are just saying, hey, we're not writing insurance anymore in this state or this area because we're just not profitable anymore.
Yeah, that's kind of scary when you think about it. And so what that comes into is actually we won't have time to cut it in this segment. I'm gonna cover it later with Chip. Probably is the doom loop that happens if they stop writing new business, right? And they're barely profitable or not profitable, as you say, and they're scared to take on more risk. And that's the actuary was telling them, open the spigot or close the spigot, so to speak. Then the only way they can get the revenue to take care of wage increases, et cetera, is to increase premiums on your renewals. And I'll talk about a State Farm article later where in California they're looking at another double-digit after last year's double-digit increases. But this one article that you sent in here, Allstate is averaging 17% hikes in New Jersey, 15% in New York, and in California, 30% they're raising prices. And then there are some folks that are getting a 40% increase in homeowner rates right now on their renewals. And these are people with no claims. Mm-hmm. So you've been a good client or a good consumer of these large carriers. You've been paying your premium year after year, and they're going to whack you with a 40% increase.
Yep.
And, if you're a senior citizen on a fixed income, that's not fair.
No. And that's
not fair for anybody, frankly.
That's what I think about the most, because obviously Retire Smart's clients and any financial firms, their clients are that age of 65 and up usually, and their budgets don't change anymore. Income stops, right? The income they're getting now is what they're more than likely going to get throughout the rest of their lives. So they don't get a 40% increase every year. Their wages don't go up like that.
Well, and the one thing is the insurance companies, the financial industry and the insurance industry, they don't have to hire oodles and oodles of employees. So their labor costs, certainly they go up, but they're getting disrupted by the claims, repairs, the vendors they have to go out and use to repair homes or roofs or cars, et cetera, and those costs have gone up significantly in the small business community. And the same thing, it's just like a doom cycle going on. So in the end here, people are either going to have to make a decision to self-insure or take on a much bigger piece of the pie or liability. And, I try to explain to people, I knew this would come to other parts of the country, but this happened in Florida 20 years ago. So in 2004, we had 4 major hurricanes, Cat 3, 4, or 5 or higher. These are the big ones. Make landfall in Florida. It was a historic year, and the amount of damage, and basically your big insurers left and never came back. Mm-hmm. State Farm and Allstate exited the building, so they haven't insured homes there since. And USAA, which is a lot of ex-military, et cetera, that's who I had forever. They stopped insuring our homes in Florida, and then the state of Florida had to create out of thin air these. We called them the boondoggle insurance companies. They were just like a Royal Bahama Canadian LTD, right? Limited. And they would create these companies, and they would, back then, they would limit their liability to like $100 billion. Now it's bigger. But and then they would create the next one and create the next one. And they were all just basically like 6 or 8 reinsurers backstopping a company that the state regulator basically created out of thin air.
Well, it's funny because it's owned by the taxpayers.
That's right.
When, in all reality. But in these articles that, like I sent you, they always talk about different states. Like you named off California, New Jersey, Florida. Like those are the, catastrophic weather kind of states and areas. But believe it or not, Nebraska usually is in the top 5 of most expensive homeowners insurance in the country.
Why do you think that is?
Tornado Alley. And that, it's not.
Well, don't the carriers know about the Oma Dome?
Yeah. Well, and I talk to my insurance reps. They'll come in. We'll have meetings and just catch up quarterly. And they're telling me, this is a unique situation or a time and period that they're in, but they have to do what they have to do to stay profitable.
Well, I can tell you, I thought my home insurance would be a lot cheaper here when I moved here than it is because I live in Florida. Now, in Florida, the homeowners insurance on comparable homes was slightly cheaper, but the exposure was much greater. So, let's just say a house called about $500,000, but it's 1,000 feet from the Atlantic Ocean. Okay, literally 1,000 feet. So, a big surge, and you could literally have water on your floors, and so you had to have 2% natural deductibles for natural occurrences, rising water, tidal waves, hurricanes, those things, that kind of stuff. And you had to have flood insurance on top of that because the water that comes from the rise is not covered under the policy. And understanding all these nuances, I want to talk just about the macroeconomic situation, because what happened in Florida is nobody could get any service. Do you know why? Because the agent, because these were state run, guess what they paid a commission? You're a licensed professional. You have to go through all this education and continuing education. You just got back from a conference. You're always trying to do the best you can. But you earn, let's face it, and it's a fair and equitable transaction. You earn a commission paid to you from the carrier when you place the homeowners or auto insurance, right? Well, in Florida, they gutted those commissions by 80% on the state run. So do you think any of the insurance brokers wanted to offer them to you? And again, it's a self-fulfilling prophecy. You think it was supposed to lower costs, ended up increasing it, because then they had to hire all these people to service the book of business because the brokers wouldn't service it, and they just left the business, and people were left high and dry, and they had to go to the carriers that would pay more money for, but they were serviced, and they were happy doing it. So I hope we don't go through that here, but anyway.
No, and we're obviously, we pay a very high percentage for homeowners insurance. This article talks about how it's keeping some people out of home ownership, which I never thought that would happen. But
we have higher interest rates right now, higher cost of insurance, and property taxes are a killer. The triple trifecta here for first-time home buyers here in Nebraska. Hey, listen, before we run out of time, we've got a class coming up where you kind of go through these types of things, how to understand what your insurance is, where you can maybe look to tweak your premiums, et cetera. Smart Insurance Protection class, that is coming up Tuesday, January 18th at 10 a.m. and again that afternoon at 6:30 p.m. So we have a morning class or an evening. You don't need to go to one of them, but you do need to get registered. But then you also, you and Kyle Schroeder and Colin Kastrick, the attorney, are doing the Smart Spend Down Solutions, which was just the most over-attended first class we've ever offered before a couple months back there. And that's coming up on Saturday morning, January 27th, 10 a.m. or again at 1 p.m., learning how to do the Spend Down Solutions. And your feedback from that one was from just through the charts, from what I understand.
Yeah, the Senior Asset Solutions one was the response that we got was unbelievable. I didn't think it was that hot of a topic, around kitchen.
Well, that's why you had to get you another setup going right here. So they can attend those. But to do so, folks, you do need to get registered by calling 402-369-7777. Again, 402-369-7777. The complimentary, but you must get registered. So in just the 30 seconds I've got left with you, Mike, can just kind of tell me at that the Smart Spend Down Solutions, kind of who should be coming to that class?
Anybody that has a loved one in a nursing facility that's paying privately. So anybody that's paying thousands of dollars every month, spending down their assets, that's who should attend that class. They will get a lot out of that. Okay, so if you'd like, and this could be your parents, could be a loved one, could be an aunt or uncle or your neighbor, and you want to learn more about how this is, and you can also start doing some pre-planning at these classes for your own spend down solutions, regardless of age. And this also applies to in-home care, correct? Yeah. Yep.
So if someone's receiving care in the home but having to pay $1,000 a month for it, that would be good. All right. Well, thank you for stopping in. I'm glad you were able to get home safely with all the weather hassles this week. We'll look forward to hearing from you soon on how these classes went.
Thanks. Hey, thanks for having me back. Appreciate it.
Absolutely. All right, Chip, what do we got next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about taxes. Actually, all of these are about taxes today. I saw that the IRS is raising the penalty from 3% to 8% on underpayment of taxes. I don't try to cheat Uncle Sam, but sometimes investments produce better than expected. Do any of your clients run into this problem? How do you manage it?
All right, so what the question is asking is if you pay your taxes, basically most people are just going to pay them through what's called payroll deduction, right? You're going to have your taxes held back from your employer, and then you're going to file your tax in the year, and either you had too much withheld or not enough, and then you have to settle up the difference when you file your taxes, basically, typically in April the following year, or at least by April 15th or 17th, whatever the day will be in the given calendar year. So when you have extra income from portfolios, or you're a business owner and your tax liability grows, you may be required to make what's called quarterly payments. And there's what's called the safe harbor rule. So basically, the safe harbor rule is if you have income that fluctuates, let's say you were in a commission-based job, you sold cars or you sold houses, you were a realtor, and you made $100,000 one year, and the very next year you had a really good year and you jumped to $200,000. Well, if you were making quarterly payments based off of $100,000 in income, so let's say your accountant told you to send $7,000 a quarter in, and you paid 28 grand or something in over the course of the year. The next year you've been doing that because that's what you're told to do, but you made $200,000. You may have to pay a tax because you did not pay your quarterlies as you earned it. The taxes is literally due in the quarter that you earn the income, basically. And so what the safe harbor rule does is it says as long as you pay through those quarterlies 110% basically of the previous year's tax bill, then you're okay and you won't have to pay that tax. So you don't have to pay it all up front when you have a big jump, but you do need to make sure that you pay through quarterly filings, et cetera, at least your safe harbor number. So if that example I gave, that person paid $28,000, they would want to add $2,800 to their quarterlies, spread it out, $700 more, and then they could settle up their tax bill with no penalty as long as it was in by the due date in April.
Boy, but you better be on it, though.
You need to know where you are.
This is another example of the many ways that you can get blitzed and blindsided on taxes.
Which is why we don't think you should be doing your taxes yourself. One of the many reasons you should hire a competent professional.
All right, another question about taxes, David. My husband and I hear conflicting opinions on whether to take the standard deduction on our federal income tax. What do you think?
Well, this one will puzzle me a little bit. The standard deduction is quite large, so that's going to be most filers today. You're talking over 85% of filers will use the standard deduction. And what this means is the difference between the standard deduction, or you're going to file a Schedule A on your tax return where you use an itemized deduction. So if you have more itemized deductions than the standard deduction, you should use an itemized deduction. But for most people, they're not simply going to have that because they're not going to have enough things to write off. So what can you write off? The primary big ones most people are going to write off are mortgage interest is the number one thing people deduct from their taxes. You can write off state and local taxes to a cap of $10,000. We call that the SALT deduction or the SALT limit. And then any charitable giving that you give, cash or non-cash, can be itemized in there as well. Plus, you may have medical expenses, but they have to be over 7.5% of your adjusted gross income. So it has to be a pretty large bill for most people. But if all those things added up are more than the standard deduction. And for a married couple this year, it's almost $30,000 basically. So you'd need a lot of So most
not
people
likely to beat that. Most people, yeah.
But with proper tax planning, this is again where we show people some creative ways to take advantage. Let's just say you're retiree, you've done everything right. You've paid off your mortgage. You don't have any debts. You've got some investments, but you live on a modest income. We see this all the time. We call it Midwest millionaires. They're not overly zealous with spending. They're pretty frugal. They're realistic. And they're donating. They tithe to a local church or they're donating to a local charity. We recently had somebody, they were donating over $12,000 a year, but they were using the standard deduction because they're a married couple, both over the age of 65, which basically puts them up at $32,000 and change this year as their standard deduction. So even though they were donating $12,000, they didn't get any tax benefits. They were giving out of the kindness of their heart, but there was no tax write-off because it wasn't over and above the $32,000 we just mentioned. So what we've done is we used the SALT deduction, which is their property taxes, and their property taxes were about $8,000. So now they had that.
Well, now we're getting closer to 30 grand.
That and the 12 grand was only 20.
It was 20.
So what we did is we actually showed them how to use one of the strategies we talk about, which is a donor advised fund, and pre-give into an account that they can basically still control and pre-give a couple of years of that donation, so the charity will still get the church will still get the $12,000 each year for the next 3. In this example, it was 3 years, so they put $36,000 into a donor advised fund. Plus, they had their SALT deduction of about $8,000, so now they had a $44,000 Schedule A itemized deduction, meaning now they got the full benefit of that $12,000 donation this year to write off their taxes. And then the next 2 years, they just use the standard deduction, and the donor advised fund will send the $12,000 to their charity. So the charity gets the money chip in the same time frame that you would have given to it anyway, and they know it's from you, but we now accelerate the tax benefits and actually get the tax benefit back in your pocket. And that is, if you're in the 24% tax bracket, that's about $4,000 back just from one little strategy we help retirees with all the time.
I love that scenario. Remember, Retire Smart includes Donate Smart. Don't back off. Donate robustly, but do it in a smart way. All right. One more about taxes, Dave. This is actually about required minimum distributions. The market rally at the end of the year was good for my portfolio, but in 2024, I must start taking RMDs. I'm worried that the gains to my portfolio might push me up into a higher tax bracket, and the higher taxes will wipe out the benefit of the market gains. Is there a way to avoid this?
Okay, so your required minimum distribution, depending on how large it is, and we don't know the numbers here, so I can't tell you, yes, that certainly can push you into another tax bracket. In fact, it often does. Retirees in their 70s, because the counts keep growing and the RMD, the required minimum distribution, gets bigger and bigger. I mean, I just worked with someone this week whose required minimum distribution is about $140,000. And so that obviously is going to push somebody into a decent tax bracket without other pensions or Social Security income. The other caveat I want to warn you of is this will also, and we briefly touched on IRMA last week, could create Medicare penalties, the RMDs, where you have to pay a penalty for Medicare both B and D for potentially for the rest of your life if your RMD continues to climb. So number one, yes, it's possible it could push you into a higher tax bracket, but it's only the dollars over that bracket that would pay the higher rate. So can you do anything about it? Absolutely. Another tax strategy, if you so happen to be any charitably inclined, is called a QCD, or a qualified charitable distribution, where you could donate a portion of that RMD. Now, there's some rules you have to follow. It should be the first dollars out of your account in the beginning of the year. You should send that to the charity, and you can actually donate up to $100,000 per IRA account owner to a legal charity, and the distribution will satisfy your RMD, but you will not be taxed on the distribution. So that's one key way. Another good idea to understand, too, is folks that have gains and have RMDs, and they're scared, hey, I had a good year in the market, but I think the market might pull back, and the RMD is based on the year-end value. So let's just say your portfolio gained from like $850,000 up to $1 million last year. So now your RMD is going to be based off $1 million IRA. And if I'm just going to pick 5% was your RMD. That's not the exact number, but if you had a 5% distribution required this year, that would mean you'd have to take $50,000 out, right, Chip?
Okay.
But if the market were to have a severe correction, big drawdown, like a 2008 or a 2001, and let's just say the portfolio fell 30% in the year, and at the end of the year, your account's basically worth $700,000, and you haven't yet taken your RMD, how much do you have to take as an RMD? It's still $50,000. You still have to take it on the year beginning value. So now percentage-wise, that's a much higher percentage of the account value when you take the distribution. So a strategy you may consider employing is get someone to calculate your RMD right now. It's in January. Let's say it was $50,000. Take $50,000 of the portfolio and just buy T-bills right now. You can go out and buy 26-week T-bills, guarantee an annualized rate of return of around 5% on those, sit on the money, and then it's there outside of the normal investments in the account. So even if that goes down, you already have money earmarked and locked in to pay the tax bill, yet you're still going to earn some interest on it between now and the end of the year, so you don't have to pay the RMD early if you don't want to.
We have dozens of strategies like that to address all various scenarios involving
we always
taxation.
say you don't know what you don't know, right?
David, we're out of time for Q&A this week, but how many openings do we have for a discovery call this week?
Just six available this week, where you'll get spend a few minutes on the phone, ask your most pressing question or concern, and it could be about anything: the market, taxation, the election we're going to have later this year, whatever it is. You can have a licensed advisor kind of walk you through what we think the answers may or may not be to whatever is perplexing you.
402-369-7777. No charge, no obligation. It's a complimentary discovery call. 402-369-7777. Up next, Jake from State Farm. Patrick Mahomes, somebody help! California is jacking up home insurance rates. We'll tell you about it next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, here's the headline this is ABC News out of San Francisco. State Farm home insurance to increase in California by an average of 20%. David, correct me if I'm wrong. If you've got a $2,000 policy, that's a $400 increase, right?
I don't think many people have a $2,000 policy anymore, especially in California.
Is that right? Okay.
I think those folks are out there. I have one friend that lives just a little north of LA, and their homeowners premiums around $12,000 a year.
Oh my goodness!
And 20% on that.
Yeah,
now you're at 2,400.
Yeah.
And
into
it's
the thousands, not the hundreds.
And I'm saying now California is really bad right now, and this story talks about State Farm across the board 20%, and they are, by the way, the largest insurer in California, the biggest market share. So that's a pretty big wallop, and this is due to not only their cost to just survive and pay for supply chain issues we talked about, to pay for claims, et cetera. It's increased regulation brought on by the state of California as well, and so they're creating new compliance loopholes and making it so difficult for even large businesses to operate with any kind of margin or profitability, which is critical, to grow the pie, which is how you create jobs, et cetera. But we're going to see more of this. We talked earlier in the show about the difficulties of insuring homes, et cetera, right now, and the challenge across the board. And unfortunately for senior citizens, regardless where they live, this is becoming an epidemic across the country, Chip, between the cost to insure your home and then just pay the property taxes is getting quite large. And I own, and as we talk about, I own quite a few pieces of property in real estate, and I have my parents each live in one of mine. I have a relative, a couple relatives that live in some of my properties, and I give them a fair market rent or a discounted to fair market rent, realistic rent. But some of those properties, I don't have any mortgages on them. I'm blessed to have been able to pay cash for a lot of those properties over the years. The cost to insure them and then the cost to basically pay the taxes on them, basically, it's almost still a net lose on cash flow. And so this is going to create problems because real estate, as we said, has gone through this amazing rise lately. And at some point, the market's going to have to soften. And, with higher interest rates, the cost of a mortgage on top of higher taxes and higher insurance, it makes a home just about impossible for someone to buy, especially their first home in today's market at the medium housing price. You can't do it on medium income, I can tell you that.
David, you're a small business owner, and I thought of that when you sent me this next article. This is from the Daily Caller, and the headline is, Biden added $745 billion worth of regulations in 2023. The source, this is a study done by the American Action Forum, which is a self-described center-right think tank on fiscal policy. You're a small business owner. What does this mean when this amount of regulation is imposed on business?
It's ridiculous, and it crushes small businesses because they have to do compliance and paperwork, or they have to outsource this, which means additional compliance costs through either legal fees or accounting fees or outside consultants to help people become compliant. And just so you know, if you are a small business owner, you must file now your FinCEN report every year on who the owner of your company is. The government, if they want to know, guess what they have to do? They should just go to the Secretary of State website. It's already there, Chip. But now you have to file this, and your attorney's the one that's going to do this for you. Most likely, you're going to have to file these reports. And by the way, if you create a new company, you have 30 days to comply. And there's jail time if you don't, Chip.
Oh, my goodness.
Jail time. Yes, it's insane. But the amount of compliance and regulatory burden put on small businesses in a multitude of industries is insane. Like I said, here, for someone to cut hair, it's during COVID that we talked about that briefly. It's illegal for you to cut your neighbor's hair, on your back porch. I'm like, what? Just like I always joke, I'm like, why do I have to have a license to feed myself to go get a fish out of the river, right? Or, hunt, But anyway, at least those dollars are theoretically go to preserve parks and recs, et cetera. But this is insane. And there's regulation in our industry. The Department of Labor put out some new rules that are being thought of, and the entire industry is pushing back. So we're just one industry that is getting the burden of all these additional regulations, et cetera. But you're talking almost $1 trillion worth of productivity here, $750 billion productivity getting wiped out every year because of this overreach of regulation. And so, I won't tell you exactly who to vote for. Well, yeah, I probably will. But, we've got to get something going in the other direction to get growth going. That's the only way we're going to save our economy and our country with the amount of debt, which, by the way, $34 trillion was passed a week ago. $34 trillion dollars, and most people have no idea how much money that really is.
Some of the numbers in this story: 251.3 million hours of net annual paperwork burden increases. Well, the business has to pay somebody to do that paperwork, that bureaucracy. Ultimately, these costs pass through to the consumers, do they not?
Well, yeah, and just so you know, that literally they added $46 billion worth of cost to small business owners basically Christmas Day. I mean, they did this the last week of the year, punishing businesses. And here's the problem: small business owners, Chip, it's hard for them to stay compliant with all the rules and regulations that evolve with employment law, with both your state or any states you may operate in, and all the federal bureaus and different agencies. Again, this is not how it was meant to be, but that's an argument for another day.
David, my eyes widened when I saw this headline that you sent me from CNBC. Big Short investor Steve Eisman worries everybody is coming into the year feeling too good, sees room for disappointment. Now, you put me on to the movie The Big Short, which I had to watch 2 or 3 times to be able to get all of it. But what a great rundown of the 2008 financial collapse. Now, Eisman, let's see. Christian Bale played Michael Burry, who was kind of the offbeat visionary, who was the first one to see it coming, the housing market collapse. Now, Eisman, he was kind of the hardball bulldog investor guy who kept making a fuss at shareholder meetings and things once he tumbled to what was happening. Is that the guy we're talking about?
Yeah, he was played by Steve Carell from The Office fame.
Right.
Yep.
Yeah.
And but he did pretty well in there, and he's out there and saying, listen, some of the optimism people are rolling into 2024 with is a little unfounded. And by the way, he was backed up with those comments. Literally, a guest behind him on CNBC was none other than Jamie Dimon, CEO of
we quote
Chase,
him often
JP
on this
Morgan
show,
and Chase, and believe in the markets will actually have a negative return this year. But now, to specifically what Steve Eisman of The Big Short fame here was talking about, Chip, was what we talked about on the show: rate cuts. Right? The Federal Reserve has said we're probably going to do 3 rate cuts in 2024, but don't know when the first one will be. The markets are pricing in 7 rate cuts as early as March. And so he's like, listen, when they don't happen, that could be, or most likely will be, a short-term catalyst for it could be potentially a pretty severe pullback in the markets. And, we talked about it briefly. The other guy from The Big Short, Michael Burry, had one of the largest short positions ever put on here at the end of the year. We talked about that briefly. And, so
yes, that's right.
These guys may know a thing or two about what they're doing. So I just heed with caution. That's all we're saying is until we kind of see if earnings are as bad as we think they are, or can they hang in there and can we actually have a soft landing? It's to be determined.
This is why the report card does a comprehensive review of your entire situation. And then we take into account all kinds of different scenarios that may be coming. One of your favorite words, David, proactive. You got to be proactive. You got to be out there checking things out. Be ready. Don't just, if you're with somebody who's on automatic pilot, stay the course and so forth, you may at least want to get a second opinion.
Yeah, and you want to find out what are you trying to accomplish, right? Are you trying to hit home runs and make 30% every year, or are you trying to grow your portfolio and protect? Preservation is the number one thing you should be focused on as you step into retirement. And then you want to grow with a real rate of return. You want to consistently beat taxation and inflation, which can be challenging to do in some environments like we have today. But that's what your goal should be, so that you still have the capital and you can still spend it and have a lifestyle that you've envisioned for your retirement.
Well, Michael Burry and Steve Eisman see cause for concern for 2024, so you need to be alert as well. Give us a call if you'd like one of those complimentary report cards, 402-369-7777. That's also the magic number if you want to join us for Smart Social Security Blueprint, Tuesday, January 9th, or Wednesday, January 10th, 6:30 p.m. It's right here in the Midwest Learning Center at Retire Smart, 402-369-7777 if you'd like to register for that. And then Smart Spend Down Solutions, wildly popular class, first time we rolled it out in December, so here we come again. Smart Spend Down Solutions. Are you wrestling with issues involving long-term care? This is for you. Saturday, January 27th, 10 a.m. or 1 p.m. We offer it 2 times. It's the same one, so choose one. 10 a.m. or 1 p.m. Saturday, January 27th. Again, right here in the Midwest Learning Center at Retire Smart. We'd love to see you, but we need to know if you're coming. 402-369-7777. 888-848-7777. David, bring us home.
Hey, have a blessed and prosperous week, and keep those driveways and sidewalks clean and stay healthy.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Michael Luna is an employee of Retire Smart and the president of Smart Protection. Senior Asset Solutions is not affiliated with Retire Smart, but is partially owned by both Michael Luna and David's wife, Melissa Brooks. Furthermore, Smart Protection and Senior Asset Solutions are tenants of and may share clients with Retire Smart.